Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Financial Management, and the course code for this subject according to the new scheme of study is BS 251. This is our lecture number 13, and the topic under this lecture discussion is the concept of security valuation. The outline of this lecture consists of the four main agenda points. Number first is what is the concept of value, and we will see the different kind of valuation concepts. Then we shall understand certain important bond terms. Thirdly, an example shall be discussed related with perpetual bond valuation. We will learn the definition of perpetual bond and then its valuation. Last but not least, an example of non-zero coupon bond with a finite life. So what is a non-zero coupon bond? And as well as having a finite life, a limited time period for maturity. So these points will be discussed shortly one by one in detail. Let's move towards next slide. What is the concept of value? There are certain terms we need to understand in order to have the good grip on the valuation concept of the security. But before understanding the valuation concept, let me explain in the topic that we have written concept of security valuation. By security, we mean an investment opportunity for the investor and as well as from the perspective of the issuing authority. Like mainly, we have two main securities to invest in as far as the investor point of view is concerned. The investor can invest either in stocks, shares, or in a debt instrument which is known as a bond investment. So as an investor, we need to know about the actual price of the bond or a share before investing our precious money into that investment opportunity. So the basic agenda of this topic or lecture is to let you acquaint and knowledgeable enough to calculate the original intrinsic value of those securities. So there are certain phenomena under the valuation concept. One is known as liquidation value. Now what is liquidation value? Let's define it with a definition and then to understand it with the help of an example. So liquidation value represents the amount of money that could be realized if an asset or a group of assets is sold separately from its operating organization. Let's take an example. What does it mean? It means that when a company is going to sell out its asset separately from its overall operating organization, the amount what the company or the legal entity is going to realize by selling that particular asset is known as liquidation value. For example, you own a cell phone or a smart mobile phone, and you definitely own certain other assets as well, like apparels, like bracelets, smartwatches, shoes, a bike, or even a car. So let's suppose you are going to sell out your smartphone in the market. So the amount of money you are going to realize by selling this asset is known as liquidation value of your smartphone. Now what is the going concern value? Now we are not going to take the personal example, rather we shall take the specific examples related with the companies or legal entity. Going concern value represents the amount a firm could be sold for as a continuing operating business. Let's suppose a company Recently, we have seen that a very famous social media company named as TikTok has been sold out as a going concern to certain United States investors. So now the amount what the TikTok owner has realized from by selling their company to another investor is known as the going concern value, because the business did not shut. Rather, it has been sold out to somebody else as a continuing operating business, which the second party is going to continue. Now, what is the book value? Book value represents the accounting value of an asset, the asset's cost minus its accumulated depreciation. Let's suppose the company own an asset named as a building. So the building value depreciates over the period of time. Let's suppose the company has purchased its building on $100,000. Let me write down over here. And every year the company is losing, not the company, rather the building is depreciating its worth by $10,000. So the remaining amount or the residual balance or the residual value of the building after 1 year shall be $90,000. Now in this case, we can also call this remaining or residual amount of $90,000 as the book value of the company's asset, which is named as building. Now, what is a market value? As we are going to understand the security valuation, so it's really important to know about the market value. The market value represents the market price at which an asset trades. Now, the trading come up over here. It means we are going to discuss about the shares, because the share trades normally on the stock exchanges. Therefore, we need to know about what's the market price or the market value of a particular share. Let's say if it is $50, then we can say that over the stock exchange, the company's A share trades at market price of $50. In order to understand and have the grip over the security valuation, and to know about the importance of security valuation, one should be acquainted with the knowledge of intrinsic value. What is an intrinsic value? This is the value where the investor is interested in to know about. Why? Because the investor is going to take an investment decision either to put his money into the stock or bond or not, depending upon the intrinsic value and as well as the market values comparison. So let's suppose the share price on the market is $50 and the investor's personal calculation let him know that the intrinsic value of this share is, let's suppose, $55. Then in this situation, the investor is going to buy this share from the market on this market price and can immediately earn profit of $5 by selling this out at a higher price, because the actual or the original value of this stock is $55, but somebody is going to sell out this share on $50 in the open market. Therefore, an investor's calculation of intrinsic value let him know either to invest his precious money in this share or not. Let's come towards the definition of intrinsic value. It represents the price a security ought to have based on all factors bearing on valuations. Now, what are those factors bearing on valuation? Definitely it's capitalization rate, it's discount rate, it is risk and as well as the risk premium, the inflation going on into the economy. So after considering all these factors into the valuation process, the price, the value one gets is known as intrinsic value. And And these two values, which are market value and intrinsic value, are very important for the investors to take their investment decision. An example of such comparison will be seen shortly in this lecture. What is bond valuation? So there are basically two kinds of investment, either to put your money in the bonds or in the stock or shares. So certain factors need to be known about the investor. Important terms we'll look shortly in this lecture. Types of bonds available in the market and the valuation process of such bonds in order to find the intrinsic value of such bonds, in order to compare it with the market value, and then to take your decision either to invest your money into this bond or to refuse or not to invest your precious dollars into this security. What are those important bond terms? Let's discuss them one by one. What is a bond? A bond is a long-term debt instrument. Debt instrument means the company is going to pay out the fixed amount of interest on this security to the depositor or to the investor. So bonds are long-term in nature, means its maturity is greater than 1 year of time period normally. And it's a debt instrument issued by a corporation or a government. Government can also issue such kind of bonds known as treasury bonds, or the corporation's company form of business organization can also issue the corporate bonds to the investors in order to do financing for the net positive net present value projects. What is the maturity value? The maturity value is also known as face value of a bond, is the stated value. It means that at the maturity time period, let's suppose the maturity of a bond is 20 years, and at the maturity, that is after completing the 20 years, the corporation is going to pay out this amount, which is known as maturity value, or the face value to the investor at the completion or at the end of 20th year, is known as maturity value. Normally in the United States, the face value of the corporate bond or treasury bond is $1,000. What is the coupon rate? The bond's coupon rate is the stated rate. It has been mentioned on the bond or security instrument, and normally this coupon is actually the interest rate what the corporation or the government is going to pay out to the investor. What is the coupon rate? It is a stated interest rate, an annual interest payment divided by the bond's face value. How to calculate this particular coupon rate? Let's suppose if face value of the bond is 1,000 and the company is going to pay out $100 on this 1,000 face value bond. So you can calculate the coupon rate by dividing the 100, which is the interest paid by the company, by the total face value, and then multiply the whole resultant value with 100, and you will get the coupon rate of 10%. This 10% is known as coupon rate on this bond. What is a discount rate? It is very important concept because this lets you know the intrinsic value. What is a discount rate? It is also known as a capitalization rate, the rate of return or hurdle rate, or we can also say the rate of capitalization or the market rate at which somebody is going to finance its operations. So its discount rate is dependent on risk of the bond and as well as composed of the premium what has been paid for bearing that risk. So it consists of basically the risk-free rate plus the risk premium for investing in that particular instrument. There are different types of bonds. One of them is known as a perpetual bond. What is a perpetual bond? A perpetual bond is a bond that never matures. So the statement is very much clear that it never matures. However, if an investor would like to take out his or her money from perpetual bond, he or she may sell out that bond to another investor and withdraw his or her money. Therefore, we can say that it has an infinite life, like it doesn't mature. So the holder of perpetual bond cannot bring back this bond to the issuer. Issuers are twofold: either the companies are issuing this bond or a government of that particular company is issuing the perpetual bond. So if the original amount an investor would like to take out from perpetual bond, then he can sell out, like Mr. A can sell out this bond if he has purchased previously after 5 years to Mr. B in order to realize the amount of investment if he or she would like to take out. So in this bond, how to calculate its value if somebody is going to sell out a particular bond on $900. Let's suppose somebody is selling this perpetual bond on $900, then the party B or the person B should calculate the intrinsic value of this perpetual bond. And if the intrinsic value is greater than the market price, what Mr. A is going to offer for sale, if the intrinsic value is greater than the offer price, then the party B should purchase this bond from person A. Why? The actual price or the intrinsic value, or we can say the price a security, ought to have bearing on all factors taken into consideration. The actual price calculated by Mr. B is $950. However, somebody named as Mr. A over here in this case is selling this bond on $900, so it's worthwhile to invest his money. He can simply obtain this bond at $900 and can later on sell out on $950 and then may simply realize $50 profit, which is known as capital gain. So the valuation or the concept of security valuation is very important with in perspective of or from the perspective of investors and as well as companies. How to calculate the actual or intrinsic value of a perpetual bond? So the formula is mentioned in over here clearly. The value is equal to the interest or coupon payment on this perpetual bond divided by 1 plus KD. KD represents the discount rate over here for the time period 1. The formula continues on with the same notation for time period 2 up to infinity. Now it's very much clear that since this is an infinite life, so therefore we have to discount the interest or coupon payment for infinite times. So it's very much difficult, and it's impossible technically to discount for longer period of time and up to the infinity. So we can also write down time start from 1 to infinity, coupon rate divided by 1 plus KD raised to the power T. If you remember the time value of money concept, if you don't, you can simply look out the present value and future value calculation on my channel or the YouTube. You can have a look on time value of money lectures and can understand how to calculate the present value of a certain notation. So it's now we can also simplify with the help of a tabular method like coupon rate multiply by present value interest factor with a certain discount rate up to infinity. Now there is no factor available for an infinite time period. Therefore, the reduced form of this formula is to V is equal to interest or coupon divided by KD, which is the discount rate. In order to understand these notations and the case, we'll see an example of perpetual bond. What is a perpetual bond example? We have a bond P named as a perpetual bond, has a 1000 face value, and it provides an 8% annual coupon payment. The appropriate discount rate in this case is 10%, and the question asks you to calculate what is the value of a perpetual bond. First of all, we have to extract the important data, which is the face value is $1,000 as mentioned clearly in this question. Coupon rate is 8%, discount rate is 10%. So we can use this final reduced form formula, as we know what is the interest on this perpetual bond and the discount rate of this bond. So we can multiply 8% with 1000 face value and we will get the coupon rate. Our coupon payment on this bond is $80. Cost of debt, not cost of debt, but the discount rate in this case is represented with KD is 10%, and the reduced form formula is V is equal to I divided by the discount rate. So it's very simple, and it's simple calculations to divide $80, which is coupon payment, by 10%. It gives you $800. As we cannot divide 80 directly by 10%, so therefore we have to transform this 10% by 0.1, which will leads towards the final answer of $800. So in this case, this perpetual bond, if somebody is selling well above this $800, then the investor should not purchase this bond because this bond is overpriced by that party. However, if somebody is selling this bond P, which is a perpetual bond, at a price lower than this amount, which is the intrinsic value, then the investor should purchase this bond because it will increase its net worth. Overall wealth of the investor will be maximized. Different types of bond consist of another type of bond known as non-zero coupon paying bond. It means that this bond is paying certain amount of coupon, and a unique feature is it has a finite life, a limited time period. So how to calculate value of such bond? The formula is once again the same. Coupon divided by 1 plus discount rate raised to the power 1. Coupon divided by 1 plus discount rate raised to the power 2. And up to the number of time period. Let's suppose if the maturity of this bond is only 3 years, then raised to the power 3 coupon payment, and as well as the maturity value or the face value of this bond. So we can reduce it with the notation summation T start from 1 up to N. Coupon payments 1 plus KD raised to the power up to T, or the final value plus the maturity value needs to be discounted back towards time 0 in order to get the original value or the present value of this non-zero coupon paying bond, divided by 1 plus KD raised to the power N. So the reduced form, if somebody is interested to use the table method to calculate the value, it's very simple to multiply the coupon amount with present value interest factor for annuity with KD discount rate up to N, and N in this case we have obtained as 3. Along with that, we have to discount the maturity value at time T, or at the completion of time T, only one time. Therefore, there is not an annuity symbol, or one should use the simple present value interest factor table for that specific discount rate and 3 number of time period as we have obtained. In order to understand this situation, let's take an example of a coupon bond with a finite life. Bond C has a face value of $1,000 and it provides once again 8% annual coupon. However, it has a finite life, like it will mature after 30 years, and the appropriate discount rate is once again 10%. So we have to calculate the intrinsic value, or what is the value of this coupon bond. The formula is very simple, as we have calculated that annual coupon by multiplying 8% with the face value, and the resultant value is $80. Since we are going to receive this $80 for the next 30 years, so therefore we have to look for the proper discounting factor in the present value interest factor table for 10% at 30th number of times. And the table 4 states the factor of discounting for this value is 9.427, which you can counter check in the present value interest factor under 10%, and n is equal to 30th number of time period. Similarly, this 1000 is the face value what the investor is going to receive at the end of 30th year. Therefore, one should discount this value back to the time 1 only single time, because we are not going to receive this 1000 face value every time at the end of each year. Rather, we are going to receive this maturity value at the completion of 30th year. Therefore, this is a single amount, not an equidistant same amount over the period of 30 years. Therefore, we have to discount it with the help of present value interest factor table, which is table number 2. You can find out in the annexure of any financial management book, or another way around, you can also search out present value interest factor table on the web and you will get the relevant table for that. So this is a table method to calculate the intrinsic value of this finite life coupon paying bond. The factors for discounting this maturity value is 0.057, and the factor in the present value interest factor table for discounting the coupon rate in table number 4 is 9.427. With the help of simple mathematical calculation, the final resultant value for this non-zero coupon paying bond with a finite life of 30 years is 811.16. If somebody is selling this bond well above $811, then the investor should refuse to buy this bond. However, if somebody is selling this bond below this price, then the investor should buy it because it will benefit their overall wealth. So this is very important for investor and as well as corporation to know about the valuation concept, because the investor is looking to opt best investment opportunity for his portfolio, either to go for bond investment or in the shares investment. And the concept for finance student and as well as the investor is important, and the mechanism to know and this all mechanism really help them to know about the intrinsic value of any security. So this is all about the bond valuation. Thank you very much for listening to this lecture. If you have any question, feel free to ask on KCMS, or another way around, if you got any problem, you can simply email me on my official email address as mentioned in the footer of this lecture. Thank you very much once again. Good luck for the day. Allah Hafiz.